Something terrifying just happened in America's financial heart, and no one in power saw it coming. On May 9, 2025, the U.S. government tried to sell long-term debt. It failed. A 30-year Treasury bond auction, the kind that's supposed to show global trust in America, collapsed in full view. Foreign buyers barely showed up. Essentially, loyal funders of the U.S. economies, with Japan and China at the top of the list, have now abandoned the United States. With $36.8 trillion in national debt and over $1 trillion in interest payments due this year alone, Washington is in big trouble. And in the middle of this chaos, President Trump blinked. Out of nowhere, Trump reversed course on his aggressive trade war, stating his willingness to slash tariffs on Chinese imports from 145% to 80%.
Turning now to President Trump's trade war as U.S. and Chinese officials meet in Switzerland this weekend. President Trump suggesting he's open to lowering tariffs on China, but the White House remains cautious, downplaying expectations.
It was a move that screamed desperation. Treasury Secretary Scott Bessent was immediately sent scrambling, trying to patch up economic relations and secure supplies of rare earth metals.
The president's top trade negotiators emerged from the meeting in Geneva touting, quote, substantial progress and appearing to confirm that a deal between the two countries has been reached.
Meanwhile, Beijing stayed eerily quiet. No threats, no press conference, just silence. The kind of silence that shows power. So ask yourself, what happens when the world's biggest superpower starts looking weak and no one wants to fund its future anymore? Before you go on, ensure you are subscribed to the channel. You can be sure of getting accurate analysis of economic and geopolitical news. Let's start with the issue of the U.S. government trying to sell long-term bonds without expected success. The way finances of the government works is that it has to borrow money all the time to keep running. It does this by selling bonds, basically promising to pay people back later with interest. These bonds help fund America's massive debt. Usually, other countries like China and Japan buy most of these bonds. That's how the system has worked for decades. But at a recent bond sale, something unusual and worrying happened. Instead of buying more bonds, foreign investors are selling off. That's why foreign countries only bought 59% of the bonds. That's much lower than normal. Because of that, U.S. banks and investment companies had to buy almost 30% of the bonds themselves. That doesn't usually happen, and it's a sign that investors are growing skeptical of Washington's ability to manage its financial obligations. The numbers tell a grim story. Military spending is now over $1 trillion per year, more than during the Cold War. On top of that, government subsidies for chip making, electric vehicles, and supply chain reshoring have passed $300 billion. But tax revenue is shrinking. Tariffs, energy shocks, and a collapsing trade surplus are eating into corporate profits. In 2024, the U.S. posted a record $2.3 trillion deficit. This year is on track to be even worse. Even worse, the interest rate the government had to offer on the bonds jumped to 4.82%, much higher than expected. Why? Because investors are starting to see lending to the U.S. as more risky, so now they want a bigger return to make it worth the risk. This might seem like just one bad auction, but it's really a warning sign that the world is questioning the long-term stability of America's financial system. Just 2 months before this bond sale, Japan, America's biggest bondholder, sold $20 billion worth of U.S. bonds. That's the largest sell-off by Japan since 2016. This is a big deal. Japan has always been a reliable partner, even when other countries started pulling back. If Japan is now selling, it means even our closest allies are starting to worry. So why is Japan doing this? Japan's economy is also struggling. Their currency, the yen, is very weak. To protect their own economy, Japanese investors are moving money back home instead of keeping it in U.S. bonds. They're choosing to help themselves first. But this raises a serious question. If Japan is pulling out, who's next? What happens if more countries, like China, Saudi Arabia, or Germany, start selling U.S. bonds too? All this unfolded just days before a scheduled high-stakes meeting between U.S. and Chinese officials. Here's the problem. The US is already buried under $36.8 trillion in debt, and it needs to borrow more money every year just to pay interest on that debt. When interest rates go up, like they just did, that borrowing becomes even more expensive. That means the government has to borrow even more money to pay for the interest, starting a dangerous cycle called a debt spiral. Think of it like this. The more you owe, the more it costs to pay back. The more it costs, the more you have to borrow. And so on. At some point, investors may stop trusting the US entirely, or demand such high interest rates that it breaks the system. By then, the US might have no room left to fix the problem. Here's the reason why we all need to be concerned. The US government bonds are more than just loans. They're the foundation of the world's financial system. Banks use them as safe assets. Governments store wealth in them. Interest rates everywhere, from home loans to car payments, are based on these bonds. And because US bonds are the foundation of global finance, any cracks in that foundation ripple worldwide, from mortgage rates to pension funds. Mortgage rates could rise. Corporate borrowing could get harder. Pension funds could lose value. Even everyday savings accounts could be affected. The only way out is for the Fed to step in by printing more money. We've already seen what happens when the Federal Reserve is forced to print money to save the US government. Just look back at the Biden era. In 2022, inflation soared past 9%, the highest in over 40 years. Why? Because the government had spent trillions and the Fed printed even more to keep up. Over $5 trillion flooded into the economy during COVID and its aftermath. The result was skyrocketing prices, a cost of living crisis, and collapsing consumer trust. Now here's the terrifying part. If the government runs out of buyers for its debt again this year, and the Fed is forced to print trillions more, the damage might not just be bad, it could be permanent. We're talking hyperinflation, a destroyed dollar, and possibly the end of US financial credibility. Once that trust breaks, there's no going back. While all this is going on, the US President Donald Trump has been scratching his head, trying to find a way out. Before the China-US meeting, out of nowhere, President Trump made a surprising announcement. He said he would reduce tariffs on Chinese goods from 145% down to 80%. There was no concrete details and no explanation, just a vague message saying Treasury Secretary Scott Bessent would handle it. This quick change shocked everyone, including Trump's own advisors. In normal diplomacy, countries only cut tariffs if they get something in return. But the timing made it feel rushed and panicked, almost like the US was trying to calm the bond market and inflation worries before meeting with Beijing. China's reaction was silence. It showed China felt no pressure to give anything in return. Economist Dan Wang summed it up. This wasn't a negotiation. It was a financial emergency disguised as policy. China didn't even bother reacting to Trump's proposed tariff cut. Why? Because China doesn't need the US as much anymore. In the first 3 months of 2025, Chinese exports to the US dropped by over 21%, a clear result of the tariffs. But instead of shrinking overall, China's total exports grew by 8.1%. The reason was China found new buyers. Exports to Southeast Asia jumped 21%, and exports to the European Union rose 8%. China is building its economy around new partners, especially in Asia, Africa, and Europe. Its Belt and Road Initiative is turning infrastructure projects into trade networks. And it's creating its own payment systems that use Chinese yuan instead of US dollars. So while the US still depends heavily on Chinese goods, China is learning to live without the American consumer. The US thought tariffs would reduce dependence on China. But in reality, Chinese goods are still entering the US, just in a new way. For example, Chinese shipments of parts and materials to Vietnam went up 26% in early 2025. Meanwhile, Vietnam's exports to the US jumped 34% in April. This means China is sending goods to Vietnam, where they are slightly changed or just relabeled, then sent to the US as Vietnamese products. This is called transshipment. It helps companies avoid tariffs, but it also hides the fact that China is still part of the supply chain. Experts now estimate that about 40% of U.S. imports from Southeast Asia contain Chinese parts or materials. So the U.S. may think it's buying less from China, but it's still paying for Chinese goods, now at higher prices. The result? Inflation stays high, supply chains get more complicated, and China still profits. Policymakers still act as if the world will always line up to buy more American debt. But that illusion cracked when Treasury Secretary Scott Bessent flew to Geneva in a last-ditch effort to secure capital and rare earth supplies. The meetings went badly. Many emerging economies, especially in Asia and Africa, are no longer looking to Washington for leadership. They're turning to Beijing. In a twist of irony, the very global financial system the U.S. built is now enabling its decline. China isn't just reacting to tariffs. It's actively redesigning the global economy. Through its digital yuan network, trade is happening outside the reach of U.S. banks and the SWIFT system. Dozens of countries across Asia, the Middle East, and Africa are adopting these tools to settle deals directly, bypassing the dollar entirely. At the same time, central banks around the world are buying more gold than at any point in the last 50 years. China, India, and Saudi Arabia. Even France and Germany are hedging, using euros and yuan for major trade deals. The message is clear. The dollar is no longer the only safe option. Back in Washington, leaders claimed Trump's May tariff rollback was a strategic reset. In reality, it was a panicked retreat. The earlier 145% tariff spike had already triggered a 23% drop in shipping through the port of Los Angeles. A classified Commerce Department report warned of a looming retail collapse. The tariff cut was a last-minute attempt to ease inflation and stabilize the bond market before the China-US meeting. But China didn't take the bait. It made no significant concessions. Instead, it doubled down, tightening rare earth exports, banning tech sales to U.S. firms, and expanding trade with Southeast Asia and BRICS nations. The message: confidence in the U.S. is broken, and Beijing sees no reason to patch it up. Other countries are quietly following suit. Brazil, India, Turkey, and Indonesia are moving away from the dollar through what experts now call stealth de-dollarization. There are no big speeches, just deliberate, permanent shifts. This trust problem is now hitting the U.S. dollar itself. The dollar index, which tracks its value against other currencies, has become more volatile than ever. Since April, the dollar index has fallen from 104 to 100, a nearly 4% drop in just weeks, signaling growing investor unease. And new trade platforms in Dubai, Lagos, and Singapore are accelerating yuan-based transactions. For the first time in decades, global crises are pushing capital away from the dollar, not toward it. Here's the uncomfortable truth. The world may already be moving on, and America might be the last to notice. This isn't a future threat. It's a live emergency. The U.S. can no longer assume it's the center of the global economy. It has to earn that place again. And unless confidence is restored soon, the next failed Treasury auction could trigger a full-blown crisis. Stay tuned and subscribe for updates. What comes next could reshape everything.